Welcome to the Macro Market Report, your weekly summary of expert commentary and market analysis across major sectors including stocks, bonds, commodities, and currencies. Let's get started with this week's insights. Larry Berman notes that the momentum trade is beginning to run out of steam. The QQQs have led the rally, followed by a strength in the consumer retail sector. However, he warns that the S&P 500, while currently holding the 200-day moving average, is unlikely to maintain these levels. He forecasts a retracement back to prior levels sometime between now and July. Chris Vermeulen agrees there's reason to be cautious. He says while the S&P bounce is technically still in an uptrend, the recent pullback was triggered by news events including Trump's tariff threats toward the EU and Apple. He highlights that institutions are lightening up their portfolios, and a rise in gold and utilities is a clear sign that global markets are concerned about where equities are heading. Vermeulen believes we're seeing a dead cat bounce similar to 2008. He expects all sectors to drop and predicts that capital will flow into gold and Bitcoin once the market hits a bottom. He also anticipates a 20 to 25% drop in housing prices, presenting a buying opportunity in about 2 years. If the bond market collapses, he says we'll likely see a massive institutional shift into gold. Gareth Soloway is watching the 5,675 level as support on the S&P and notes the QQQs have surged 30% in 6 weeks. He anticipates a pullback to around 490. Soloway sees the U.S. 10-year yield and the dollar trending lower. Bitcoin is currently pulling back, but he maintains an upside target of 113,000. Gold remains in a long-term bullish pattern, consolidating, while silver may climb to $34.50 with further upside from there. Oil continues its downtrend, with support near $55 and resistance at $65. Natural gas remains stuck between $3 and $4. Victor Adair, on Michael Campbell's Money Talks podcast, highlights that U.S. bond yields are at 18-year highs, with a 30-year yield back above 5%. Capital is no longer rushing into U.S. bonds for safety, and other currencies are beginning to rally against the dollar. David Wu emphasizes the disconnect between the markets and geopolitical reality. He says the stock market is trading as though the trade war is over, but in his view, it's far from resolved. With Trump's July 9th deadline for reciprocal tariffs approaching, Wu expects high volatility over the next 6 weeks. He recommends lightening up portfolios and taking profits. Wu is long gold and short the euro. Tony Greer, on Palisades Gold Radio, notes that predicting market trends is particularly difficult right now. He views gold as a critical store of value, with central banks continuing to accumulate it. Although he cautions about the metal's current high levels, gold miners are performing well, but it remains to be seen if institutional investors will rotate into the sector. Greer also comments that bond yields could continue rising. While headline inflation numbers look tame, real-world costs remain high. He believes energy stocks could rebound if oil stabilizes, but remains cautious about their profitability at current price levels. Greer is bullish on Bitcoin and believes the S&P could eventually rally to 6,000 and even 7,000. He remains skeptical about the dominant recession narrative, suggesting it's better to watch market trends and central bank behavior. On the Macro Dirt podcast, Tony Greer and Jared Dillian discussed the Japanese bond market, saying it is quietly unraveling. Dillian remains long the dollar and expects a bounce over the short term. He also notes that fertilizer stocks like Mosaic are breaking out. Eric Nuttall expects oil prices to remain in the $50 to $60 range for the next 9 to 12 months. He points to rising global oil inventories, breakdowns in OPEC discipline, and a structural decline in U.S. shale. On the other hand, he's bullish on natural gas, citing strong free cash flow, constrained supply growth, and rising LNG demand. Keith Richards sees emerging opportunities in coal over the short to mid-term. Despite being out of favor due to environmental concerns, Richards believes coal will play a crucial role in powering AI, crypto, and data centers while nuclear facilities are still under construction. He likes Natural Resource Partners, NRP, a royalty coal stock that pays a 5% dividend, and Alliance Resource Partners, ARLP, which pays 3% and has fixed contracts targeting Bitcoin and AI-powered energy needs. Justin Huhn agrees that uranium and nuclear are gaining traction. He warns that Western utilities have secured only a fraction of their annual uranium needs in long-term contracts. The East dominates uranium enrichment, while the West demands 70% of global nuclear fuel. Huhn expects uranium prices to rise in the mid to long term. Jordan Roy-Byrne notes that precious metals have outperformed again this week. He expects gold to continue a bullish consolidation into August. He's looking for silver to test the 34 to 35 resistance zone and potentially move toward 40. He also sees gold and silver miners exceeding short-term expectations. Shane Williams on David Lynn's podcast says that $3,200 is now the new floor for gold. He expects gold to consolidate over the summer and rise again later in the year due to recession risks. Large miners are generating strong cash flow, and Williams expects an uptick in M&A activity in the sector. Luke Gromen remains very bullish on both gold and Bitcoin long term. He believes the next 5 to 7 years will be extremely volatile. If the markets were to drop 30 to 35%, he expects the decline would only last for 3 to 4 weeks before a sharp recovery. He warns that if Japan's bond market collapses, the Bank of Japan will inject liquidity, effectively sacrificing the yen and boosting gold, Bitcoin, and equities. While gold miners may rise, Gromen's preference remains physical gold. Steve Hanke, on David Lynn's podcast, warns of a recession in the second half of the year. He criticizes the Fed's focus on interest rates rather than money supply, and says it's fueling economic instability. He believes the bond market has already priced in the risks related to tariffs and U.S. policy, but the equity market has not yet caught on. Patrick Ceresna draws attention to platinum and palladium. Platinum has broken out after years of consolidation, and the same pattern is emerging in palladium. He believes both metals are under the radar and deserve close attention moving forward. Ceresna also points to a 30% correction in the Mag 7 stocks from all-time highs. Although they've rebounded in the short term, he warns of limited business clarity due to tariffs and fiscal imbalances. Tight Fed policy, widening credit spreads, and visible cracks in the bond market are all creating recessionary pressure. He expects the S&P to pull back to the 5,700 level and test the 50-day moving average. Ceresna sees oil as oversold and gold remaining strong into the second half of the year. Uranium, he says, is pausing at its 50-day moving average with long-term bullish potential. On Michael Campbell's Money Talks, Sylvain Charlebois highlights diverging food inflation trends. In the U.S., food inflation is dropping, while in Canada, it has tripled in just 2 months. He says the best ways to bring prices down in Canadian grocery stores are to increase competition, reduce packaging, eliminate provincial trade barriers, and abolish carbon taxes. Campbell also warns about Japan's financial fragility. Japan is now in worse shape than Greece was and remains the largest foreign holders of U.S. debt, over $1.1 trillion. If Japan is forced to unload its U.S. treasuries, it could drive American interest rates higher, push the U.S. dollar lower, and pressure other nations to follow suit in dumping U.S. debt. That wraps up this week's Macro Market Report. If you found this helpful, be sure to like, subscribe, and turn on notifications so you don't miss next week's episode. Stay informed, stay prepared, and we'll see you next time. Oh, golly, pardon me. It must have been the beans I had earlier.